I hope you're doing well. In today's video, I would like to give an overview on Fibonacci ratios and extensions, which are perhaps one of the most common and popular technical indicators, yet they are grossly misunderstood. One of the biggest misconceptions regarding Fibonacci ratios and extensions is that they are predictive in nature. Nothing could be further from the truth. Fibonacci ratios do not tell you that a particular security is going to take a support at a particular level. They only tell you what to do if a security were to take a support at a particular level. And there is no way for a trader to know whether a security would take a support at a particular level. However, a trader could plan his or her trading behavior as a function of what level the security takes the support of. I do not mean to complicate it by use of language. However, let us just understand this concept a little bit more in detail. Fibonacci ratios are commonly used for a wide variety of reasons. They derive their application from arts and from sciences and are popularly used by various traders. What these ratios, so where we have already understood that an indicator like an ADX, for example, when trading at a level above 25, it is safe for us to assign the nature of the market as trending. So for example, here we are seeing the indicator at 34, we know that this market is trending. In order to assert the direction, it is very easy. We can simply use moving averages. For example, I have used the 50-20 moving average cross, and by looking at the orientation of the moving averages, it becomes very easy for us to assess that this is upward trending in nature. We could also use certain indicators, for example, the directional movement, where we can see that on selecting, for example, here I will mark the ADX on a blue line, the negative DI with the red, and the positive DI with the green, and darken the ADX to share that the ADX is trading at 34 and the green is trading above the red, indicative that this is a trend with a long bias. So, these are of course the indicator methods of telling us whether a particular security is trending or not. What Fibonacci ratios are trying to tell us is how strong is the trend. To determine how strong the trend is, we need to establish where is the pullback. In other words, the strength of a trend is a function of the pullback. Similarly, we could also replace the word pullback with throwback if we are dealing with a downtrending market. Yeah. So the strength of the trend is the function of the pullback or the throwback. There is no way for a trader to decisively conclude that the market is going to take a support at a particular Fibonacci level or not. However, we can plan. So let us understand. So first step in connecting the Fibonacci would be to select the most visual and obvious pivotal highs and lows. So we will first connect the low with the high, because here we are looking at a uptrending market. So when we are looking at an uptrending market, we want to connect the low with the high and vice versa for a downtrending market. So for the purpose of calculating Fibonacci ratios, what these ratios are essentially saying is that for a market that can move from 7,500 to 18,600 in a single go, if the market takes support near the 15,950 level, then it is pulled back 23% of the full move, which is 1/5 of the full move approximately. A pullback of 1/5 of the full move and a support at this level would imply that this market is bullish strong. Once again, I'll repeat. If a market is to move upwards and pull back just 20%, where after pulling back by just 20 to 25%, the market takes support and subsequently takes out the previous high, there should be no ambiguity that it is only possible if the strength of the market is strong. The trend strength of the market is strong. Just for visuals, for example, I will just take a line. We know that this line is reflecting an uptrend, right? Because we are clearly seeing a higher top, higher bottom, higher top formation. But if I were to ask you which of these uptrends is stronger, then what would be your answer? Would it be the first case here or would it be the second case? If you chose the first case, then you're correct. The reason is that the strength of the trend, an uptrend has to move upwards, therefore it is an uptrend. But how strong is the uptrend is a function of the pullback. Now, for example, if I were to simply take the Fibonacci retracement and connect this low with this high, I will see that there is a pullback of just 23.6, which is our premise for a bullish strong trend. Whereas if I were to take the same Fibonacci retracement and connect this low with this high, you will see that there is a pullback of around 61 to 78 level, indicating that this is a very weak bullish trend or a range with a long bias. So therefore, the degree of pullback determines the strength of the trend. And since we cannot determine the strength of the trend in advance, what we can do is make a plan. So what would a plan look like? Once the market has clearly created a new all-time high, I'm just erasing these points, these elements from the screen. So once the market has clearly created new highs, we know we know that this is a bullish trending market, but we do not know how strong is this bullish trending market. Now if we are trend traders, we want to buy the pullback. Anyone who's investing in the market for the long term is looking at the Nifty 50 monthly time frame chart, because this is the security that impacts their decisions. So now, as an investor, since I do not know which would be the final support or the resting point of the market till finally the market takes it out, I will set up an hypothesis. That is, if the pullback is till 0.23 fib level, that is 1/5, I will target 1.78 of the move. Similarly, if the pullback is till 38 fib level, I will target 1.61 of the move. If the pullback is till 0.5 level, I will target 1.5 of the move. And finally, if the pullback is till 1, I will target 1. So let us just understand this. We are currently seeing that the market is trading above the 23 level, which means that if the market indeed is to just take the support of this level and eventually take out this high completely, we would know that we are in a bullish trending market and our first point of target would be 1.78, which is captured like this. So I will again select the fib retracement, but this time I am looking at 178% of the move on the downside. So I will connect these points here. So just remember, we have a market that has pulled till 23% and not till 38 or 50, and just take a note of the values that at 23% we are looking at approximately 16,000, at 38% we are looking at 14,300. So just I'll remove this for the sake of visual, and here we will see that I have connected the high to the low, but we are not seeing our target levels. So what I will do is I will just make an adjustment to the settings here, and I will make the settings that are relevant to me. All right. And now what do we get here? We basically get that for this particular security. So if I were just to simply take this somewhere here, we are not being able to see this visually, but we are getting that. Let's assume that the pullback were till 0.5, then the target would be 20,070. Due to limitation of the screen, I am not being able to show you. However, it is fairly easy to calculate that 1.78 will be 20,600. Alright, which means that the only reason why a trader would attempt to buy at the 23 Fibonacci would be to target 178% of the downward move, which would be somewhere near 20,600. Now, let us consider a case like this. Let us say the market were to not stop here. Let us just connect this line here. I'll make this black and I'll make this darker. So we have this one line here, and let us say the market were to pull back all the way till here. Then clearly we will see that this is in the Fibonacci 1 range. And here what is the trade plan? The trade plan is that a security that can create a double bottom could also in theory create a double top. Alright. Similarly, if the security were to only move till here, which is somewhere around the 78% Fibonacci, then we are saying that yes, the security has created a higher bottom. However, this is so weak that this security is almost behaving like a range, and therefore we will only take a bet of a partial break on the previous high. Likewise, if the same security were to have a pullback till, say for example 1.5, then we would say that the pullback is far more shallow, therefore the trend strength is far greater, and therefore our targets are far higher. You will note that the manner in which the Fibonacci ratios and the extensions tie up lays the foundation of many harmonic patterns and also lays the formation of various wave counts that most Elliott traders are doing. However, Fibonacci's offer the use of simplicity in that every broker, every software platform has these indicators, and the user need not go through any complex methodology in calculating them or using them. I'm confident that you would have learned a few new things on this subject, but you would also note that I have chosen the monthly time frame simply because it is the least noisiest time frame, and it is very easy to take decisions based on trending nature of the market on this time frame. A very poor place to use a Fibonacci setup would be something like this. This is very bad. Often you will see internet service providers making claims that something has moved from here till here, so therefore the targets will be somewhere here. These are not true. Remember, extensions and pullbacks only, throwbacks and pullbacks only work in trending markets, and here what we are seeing is the very definition of a range. A range could have a bias. A range could have a bias. However, till it does not trend, there is no pullback, which means that it is perfectly natural for this range, for this security which is trading somewhere here, it is very natural for this security to come and retest here. So if I just make this a little faint, so the price action that I'm saying is something like this. It's very easy for us to visualize that there are hundreds of examples and thousands of case studies where securities do this repeatedly for decades after decades. Yeah, we know of several. We also know of a few cases where the securities take this out. So a better example would be a security like this. Now, if we were to look at the security at this time, we would no doubt be saying that this is ranging. Yeah, so this is the range of this particular security. Very safe to say till somewhere here. Now, it might look like eventually the range did break here, but we must understand that this is 2007 and this is 2022. So essentially, there was a period of almost 15 years, maybe a little earlier than 2022. This is coming at around 2020. So we're looking at almost 13 years. It took the security 13 years to break the range, and therefore that you have to be at the right place at the right time, which means that in a standard trading day, in a standard trading year, there are 250 trade sessions. Sorry, there are 250. Text. I do not know why this is not working. Well, I do not know. Now it's working. So there is some issue with the line. So I will just place this text here. The point that I'm trying to make is that in a standard trading session, calendar year, there are 250 trade sessions. Yeah. And in obviously in 13 years, there would be roughly, I mean, how much? 3,250 trade sessions. From those 3,250 trade sessions, there happened to be these one odd decisive trade sessions where this stock took support at a pivotal bottom and eventually went on to take out its high. What are the odds? So here we are looking at 1 is to 3,250 odds when we are only dealing at one security level. If you were to do an analysis of the entire market, how would you determine for sure that this was the low at which point the security is going to create a new high versus, say, for example, this being the low? So there is obviously work and there is obviously study being done. But here we can see, so earlier where I was discussing with the stock like NTPC, which is still trading in a range, and we have seen that securities can trade in range for decades. We have seen that security which is broken out of the range which it was earlier trading in for decades. So all cases exist, and our role is to simply, so there is no ambiguity that this is a trending security. And whenever we have a trending security, it is very easy for us to use Fibonacci retracements, because all we have to do is look at the obviously previous pivotal point and connect it with the obviously previous pivotal high. And here what are we getting? We are getting that this particular security is taking support near the 23 and the 38 level. We had the market taking support at 23, whereas this security is taking support at near the 23 and the 38 level. If this security were to break this high, we clearly have established that for 23 we have a target of 1.78, whereas for 38 we have a target of 1.61, which means that this same thing, I would arrange it here. And now I know that since this has taken a support of 38 level, 1.67 is 867. Therefore, I would comfortably buy the security at 782, which would be a break of its high, for a target 867. And I would set 751, which is the previous fib level, as my stop loss. Now, you could set 751, you could set 727, 711. The decision is entirely yours. The farther away your stop loss, the fewer the quantity you will get. Consequentially, the greater the accuracy, because your stop loss is so far away, it might never trade, but less risk adjusted returns. And these are the decisions that a trader is constantly trying to take, which is something that I will discuss with you in the future. But as of now, the idea was to demonstrate that we should preferably use Fibonacci extensions and retracements in a clearly well established trending market. And in markets where there is a lot of noise or a lot of confusion, all we want to do is focus on the previous pivotal high and low. And a simple example we discussed was that of NTPC, which is ranging and not an appropriate place for Fibonacci, whereas Bharti Airtel, which has broken out of the range and is a much better chart for Fibonacci extensions and retracements on the monthly time frame. To understand the impact, just quickly, let's say for example I were to lower the time frame from monthly to weekly. Now, if I were to lower the time frame from monthly to weekly, you would obviously note that this is an area of support. I mean, this is a pivotal low. However, what you would note is that this is also an area of pivotal support. Correct? Here we can clearly see that the market has traded here for several weeks. This particular zone has been traded for at least 8 weeks, and this particular high has remained in play for several months. So we have approximately 15 weeks or 3 months of high within this particular zone itself. It's a very tight band. Now, when we are seeing this as the pivotal low, what would the trader naturally do is connect the pivotal low with the pivotal high and see where in that zone the stock takes support. Now, all of a sudden, what are we getting is that the weekly time frame trader is seeing the market pull back till 61 fib levels. The weekly time frame trader is seeing the market pull back all the way to 61 fib levels, and we have understood that for such a trader the target is going to be 138 fib levels. So I will simply connect this here, and now I will see that this trader will be buying at 15,656 for a target of 19,723. Now, what would trigger the buying? What would justify the buying? Would the trader do an analysis on the weekly, monthly time frame and necessarily buy it on the same time frame? Would Fibonacci, ADX, moving averages be the only indicators? How much money does the trader bet in that trade? What securities does the trader use to cover? These are all factors which are so random and so variable that these choices itself sometimes determine the success and failure of a particular trader. So while we cannot predict success and failure, we certainly can study. I hope that this session was useful to you in some way, and I will see you soon sometime. Take care.